Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Corn futures continue to be under pressure, and the farm tour this week is not helping much at all. We had a very key level for the September contract that set at 347. Upon crossing that number, we believe that a minimum price objective of 340 and a quarter was highly probable. It looks like the market is approaching that number very quickly. Beyond the 340.25 number, we're looking at 334.5. And again, this also looks to be very probable in terms of the price direction that we're looking at. After having measured the first drop from this market, we looked at a one-to-one correspondence, and that one-to-one correspondence did live at 357. Upon breaking 357, we believe that the next key level again was at 347 number. And given the weight of the weakness that we're seeing, coming down to about 334.5 before coming off the board appears to be probable. We did reach an SR7 zone today, which suggests that we could find a bit of consolidation over the next 2 days. Additionally, we're sitting at the 360-degree mark at 344 and a quarter, again telling us that if the market's not able to regain near these areas here, that downward pressure is likely to continue. December corn is also hitting on a few key thresholds. 2 standard deviations below the point of control sits at 355.5. And today you can see that's very close to where our current lows came in for the trading day. Corn continues to show weakness as discussed previously, and of particular concern right now is the small continuation pattern that is establishing itself in this market now. As we can see, we saw a very big drop coming into this contract, suggesting that another drop in a similar fashion on the other side could very well occur, pointing us to a price threshold of about 335 to 340. When we take a look at a full cycle down to the 360-degree mark, we can see that target near that 340 number lands very close to the 360-degree mark at 344.5. This then suggests to us that the market has continued weakness ahead, and this price target of about 340 or so looks to be hit. Earlier this week in our newsletter, we suggested that 944 and 3/4 to 945 would perhaps be very good resistance for the September contract this week. As can be seen here, the market gapped up some and then came back down and found great resistance right up against that level that we discussed. From here, we think that support sitting at the previous lows near 918 looks like it will probably hold this week. And from here, we anticipate that once the market's able to find itself from this area, that we should look for another move to the downside. As this week is drawing to a close, we do anticipate that upside resistance and support will remain inside of this band for these next couple of days, from which point we think that the market then looks to continue on its way back down. We're only about a week away from first notice date, so a price target of about 900 is perhaps a reasonable price objective for this contract prior to coming off the board. Part of the support that we've seen from the latter part of last week and this week can perhaps be attested to the market coming into volatility-based support. Oftentimes what we'll find is that when the market comes in to reach volatility-based support, we can see a sideways to slightly upward movement for about 5 to 7 trading days. From here, the market did make its way up, and now we're looking at resistance overhead near 943. And in doing so, if the market comes back down, a retest of previous low of about 912 is possible. And again, we're looking for the market to perhaps come back and retest somewhere in the neighborhood of 900 prior to coming off the board. As would be expected, the November contract looks very similar. And from here, we can see overhead our upside 1x1 angle proved to be very nice resistance overhead. Additionally, we have at the 950 mark a very nice resistance zone for this contract. And from here, we have support down below, which is 1 standard deviation below the point of control at 918 and a quarter. And so we can see again that the market continues to hold in a very nice tight trading range for the last week and a half. And once this market's actually able to break through either side of this range, we look for continued momentum to then kick in from there. Similar to the September contract counterpart, we can see here that the 270-degree mark also is very good resistance overhead at 952. And we can see that the market actually bounced off of its cycle low at the 360-degree mark at 921.5. It's sitting inside of volatility base support, and we can see the consolidation that occurred, and which is consistent with what we've found historically for this particular indicator. Massive global supply has made it particularly challenging for wheat to find any form of support. This market continues to drive lower, and we now have a price objective coming in at about 381.5 for this particular contract. We are approaching first notice date, so its ability to get down to that 381 number may be suspect, but a minimum price objective of about 390 is what we would have in the top end of this actual trading range of this target projection zone. So from here, the market, in fact, is very close to hitting that number, but what we want to also pay attention to is the potential for a nice market bounce coming in, which is very close to our time factor of August 24th. In doing so, we would look for the market to perhaps come in, make a slight low near our target zone here, and from here we can potentially see a market that actually moves up for a few days going into our September 5th time cycle. From there, the market can then resume its downtrend, but for now, we anticipate continued pressure for the wheat complex going forward. Our time cycle for tomorrow coincidentally happens to be very close to our 360-degree mark at 398 3/4, and we are also sitting right on top of volatility-based support. This tells us that there is potentially a good chance for a reasonable low to come in tomorrow and for the market to bounce for a few days. The December contract is also sitting right inside of volatility-based support, and there is an overlap for the two zones. And our price objective coming in between 425 and 398 shows us that the market is actually very close to that target threshold. The time factor for the December contract actually happens to come in on the 28th. So from here, we would not be surprised to see the market to continue lower. So given that we have a small window between the 24th and 28th, the market could very well come in and settle itself across that time parameter. And from there, the market would then look to perhaps move up for a few days before resuming its downtrend. December cotton continues to move in its volatile ways. In our newsletter, we had two very important levels that we were looking at in terms of determining whether or not this move would continue lower or if the possibility of upside would resume. Our two levels sat at about 69 versus our 66 number. Our suggestion was that if the market broke 66 prior to getting back above 69, that the market would then look to break lower and give us significantly new lows. If it were able to regain that 69 number and close above, then we're looking at a market then that could in fact come back and retest that 72 target that we first discussed weeks ago. The market gave us a very big move to the upside, has yet to close above that 69 number, but appears to be poised to make that move back up to the upside. And so for cotton right now, we're looking at a very critical movement for it, as well as a critical time horizon of August 30th. So if this market continues to move higher up into this August 30th number, we could see a small pullback from there. And if it does in fact close a number of times above the 69 number, we like the prospect of this market once again making a run for that 72 target that we've discussed some time ago. We've translated our data from the September contract onto the December crude oil contract, and we can see some significant data here that tells us that the market potentially wants to move higher. Initially, we discussed the 1.272 Fibonacci ratio number as key resistance. Had this market been able to close above this level of 51, that would suggest that the market would potentially move higher with the minimum price objective of 52.80 with the potential of reaching 54.75. Instead, the market did pull back from that 51 number, and it did find support near that 50% retracement, telling us that the market could very well head back up instead. This key support that we're now finding tells us that if the market continues to move higher and in fact does close above this 51 number, which happens to coincide with the 180-degree mid-cycle price factor, we would then be looking for the market once again to reach that price objective somewhere in the neighborhood of 52.80 to 54 and change. We believe that this is highly probable now for the market, especially if it's able to get back to this to the point of control number of 49.93. This market found some trouble just below this number here, continues to find support, and is showing us that it's making higher highs and higher lows, suggesting once again that crude oil could very well be on its way up. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.